Good day, fellow investors. I wanted to bring a different company today, but somebody in the comments asked me about Vale, and keeping with the topic, launch with Petrobras around Brazilian stocks, here we are. Okay, so from a value investing approach, we want to look at meaning moat management margin of safety. What is Vale? Vale is a global mining giant, iron ore, nickel, copper, but it's cyclical and highly tied to China and global demand. Vale's moat relies on its scale and high-grade ore premiums, offset by higher shipping costs versus the Australian peers. Management strengthened the ESG after multiple dam disasters, exited coal just before prices went up, and investing heavily in the transition metals. Recognizing especially the strengthening of ESG approach, S&P recently upgraded their credit rating. From a margin of safety perspective, Vale is similarly profitable to Australian peers, yet trades at a discount, likely due to its Brazilian status. Further in detail, meaning, as said, Vale is a global mining giant with iron ore, nickel, and copper focus. It's highly cyclical, tied to China and global demand, as we will see later. Its shareholder remuneration policy was recently updated in late August to 30% adjusted EBITDA minus sustaining investments, and they aim to distribute these semi-annually. And of course, because they're a Brazilian company, by law they have to pay out 25% of adjusted net income. Don't forget, they have as a miner huge risks, operational risks, and we can see that they had huge mine disasters in Samarco 2015 and Brumadinho 2019. More on those later, because those are still hanging above the company financially and reputationally. So on their shareholding structure, the company is not government controlled, although the government has 12 golden shares, which have some veto rights over certain corporate matters, like company name changes, registered HQ, mining operations, liquidations of the company, and disposable and termination of core mining systems. Let's look at the iron ore market in general, where Vale gets most of its income, as we will see later. On the top right, you see iron ore exporters by country. Australia is by far the largest. It's 54% of all iron ore exports as of 2023. They have three major companies: Fortescue, BHP, and Rio Tinto. And the second one on the list is Brazil, which is 24% of global iron ore exports, with Vale leading. They basically cover 78% of all iron ore exports. So Brazil and Australia is dominating. On the left side, who are the buyers? So top iron ore importers, major importer is China, 74%. As we will see later, Australia has an advantage because of shipping costs there. And then you can see following that Japan, Korea, Germany, Taiwan, and all the other countries on the left. Let's look at segment breakdown of Vale. On the left, we see net operating revenue by region, so it's not a surprise. 51% comes from China, and you have then Japan, Asia without China and Japan, Brazil, Europe, and other countries. On the right, you see adjusted EBITDA for Vale specifically. As said, they are heavy in iron. 91% of their income is EBITDA is coming from iron solutions, and transition metals, the other part, which is copper, nickel, mainly. Okay, what's the moat for Vale? Being a commodity producer without any product differentiation, really, they are reliant on being low-cost producer to compete. So they have a huge scale with ports, shipping, rails. Hence, they have low-cost production. But on the right chart, actually, you can see a comparison at the unit cost level, sometimes called C1 unit cost or cash cost. You see Vale is not the cheapest. So Vale, actually Fortescue is the cheapest, followed by BHP, then Vale, and then Rio Tinto. And this is also reflected in the return on investment. On a 7-year average return on investment, you can see Vale and Rio Tinto only relative to their peers are 10%, while BHP and Fortescue are higher. Don't forget that BHP is not as reliant on iron ore as Vale, while Fortescue is more reliant on iron ore. So they are not completely mirrors of each other, but they are in the similar business. So that's still a good barometer for us to use. Higher grade ore sells at a premium to Australian peers. So in theory, Brazil has and Vale has higher iron content in their ore, up to 65, even 67% FEE content, compared to Australia with 58 to 62, maybe 65, some new operations. But analysts were questioning Vale because these premiums are not reflected as much in their numbers and as you would expect them. Technically, 65 FE content would mean a 20% premium over a 62 FE content. And of course, their major disadvantage compared to Australian peers is the distance from the major buyer, China, and that leads to higher shipping costs. Although politically, China might prefer long-term buying from Brazil than Australia, but haven't really materialized in today's environment. Management. So I really like to focus on CEO pay and management incentives. You can see on the right that Vale CEO is surprisingly well paid compared to Australian CEOs, which was I didn't expect to see this. And their incentive structure, I don't 100% like it. It's not as transparent. So if you look at the peers, they have really clear KPIs. While on the other hand, Brazil is Vale has the total shareholder return. Fine. I wouldn't focus on share price. I would focus on the business, but fine. ESG target makes sense given its business and dam disaster history, and the return on invested capital makes the most sense out of this. My issue is that we don't get as clear targets and ranges as for the other companies. So Vale ESG focus after dam disaster makes sense. S&P also improved their credit rating, partly because of these efforts by management around risk controls. They exited coal late 2021 December. They signed the deal just before coal prices shot through the roof, so that was a really poorly priced exit, poorly timed exit. Investing in nickel and copper and these transition metals, we will see about that. Today we see kind of a price deflation for nickel especially, so it's not as profitable as some might have hoped to be in transition metals. And I want to keep the remuneration history now in the management section of this video, because I mentioned in the Petrobras video that these commodity companies tend to buy back shares when they shouldn't actually buy back shares. So you can see on this chart, red is Vale's share price, green is the iron ore price. Those two basically track together. So when the iron ore price goes up, you have the share price go up. And then obviously the purple is the free cash flow, dividends, buybacks. You can see when you have a lot of free cash flow, your shares are high, life is good, iron ore price is high. So at that moment, what do you do with the extra cash? I think the best is to pay down debt and pay out dividends. But commodity companies do what actually Vale to a certain degree did in 22 and 23. You can see the free cash flow drops down in 23 and buybacks kick in. And 22, 23, buybacks kick in. But look at the chart. The chart is going down. Iron ore price is going down, and they are buying the dip. So today, look at 2024, 2.7 billion buybacks. Like, if you just kept the money or anything else, you could have bought back shares much cheaper today than 2 years ago. So that's what I don't really like about commodity cyclical companies. Margin of safety. So let's look at valuation. I have a lot of numbers here. Just simplifying it, the company, I believe, has an intrinsic value based on prices projected for iron ore, which sits around, let me use a tool here. Iron ore prices 100 to 90 in the foreseeable future due to China's demand not being as healthy as it used to be due to their own real estate crisis. still ongoing. You also want to look at, of course, pellets have a higher margin, as discussed, with a higher Fe content, copper break even, and nickel break even prices. So prices and break even prices, right? Based on all of these projections, you have a price of an underlying commodity minus your break even multiplied by your production, and then you can deduct your capital expenditure plans. You have capex projected by a company to be around 5.9 billion going forward. But I also deducted commitments. What are commitments? So we have to go back to their dam disasters. They are still paying, Vale is still paying for Brumadinho, for Samarco, and then because of the restructuring of these dams, they are paying for decharacterization, which is to make the dams more safer. All in all, you have a huge, in 25 especially, a huge 3.6 billion, but you have billions and hundreds of millions going out, which are deducted from their free cash flow. After I account for this, I arrived at the $12 intrinsic value with a 10% discount, using conservative assumptions around commodity prices, a projected capex by the company, deducting the commitments. And on other financial metrics, Vale has a relatively healthy debt to equity. Their return on investment is nice. Their return on equity is great. So I think Vale has a solid base. Although it's not a compounder, so it's more like a cyclical play. You want to buy it cheaper, and then it can be a long-term value for you. And as on the Petrobras video I mentioned, every stock will be added to the stock summary table with specific KPIs and margins and whatnot to compare long-term all the stocks we look at and keep these updated. So Vale video was born due to a comment. So I do listen, and if you have any other ideas what you would like to see, please let me know down in the comments. If you enjoyed, like and subscribe. Take care. Bye bye.